Hello and good afternoon to our next New Economy Shortcut. And we're very happy to have a very brilliant author of a recent book that we're really interested in, it, which is in the midst of something which is not really the big headlines anymore, but that still is interesting to look at. So happy to have you, Mark Blyth from Brown University, and you have written this book with a co-author on inflation, a guide for losers and users, and or the other way around. And it's fascinating to discuss this because there has been a time 2 years ago, 3 years ago, where inflation was still very high, and there was a lot of noise about the reasons for inflation, and slightly something like a rollback of in sort of a classical economic way, monetarist view of economics and this inflation phenomenon. And a lot of discussions about the reasons for this inflation and for why it came up and how to fight it. And suddenly, I mean, not suddenly, but at some point, inflation went down again quite well. And the discussion has not really continued. I mean, we're still at these lower levels of inflation, but the big question is, what are the lessons? What are the lessons of this discussion? It was quite very striking in Germany and in other places between two different sides. And so it's not about who has won the discussion or the dispute, but what are the lessons? And that's exactly what you are trying to do in your book, what you're doing to try and learn the lessons of this period and to see what has changed and what can we learn for maybe next inflation periods. So I would like to invite you to give us an overview of your main ideas, the main things that you want to bring about. And then we will have a discussion, an open discussion to the public, to whoever wants to intervene. Mark, please. Thank you.
Well, it's great to be with you. Thanks to everyone who's came in online. I hope you find this to be a good use of your time. So let me take a few minutes and just lay out sort of some of the core ideas in the book. So the first one was I had a postdoc called Niccolo Fraccaroli, who's my co-author. And Nick walked into my office one day around 2021 when inflation was beginning to kick off and said, "We should write a book about inflation." And I looked at him and said, "Why? Don't we know this story? Always and everywhere a monetary phenomenon. They're going to attack it with interest rates. Hopefully, they don't cause a big recession at the same time because that would be bad. What is there to say?" And he said, "Well, there's a couple of things. The first one is, and this was at the moment when you had, if you will, the Larry Summers version of the world, which was basically a kind of back to the 1970s, watch the labor market, it's going to overheat. And Paul Krugman on the other side, which says, no, it's not the 1970s, it's the 1940s. And this is just something that basically is a supply shock and is going to dissipate. And Nick said, there's very different ways that people are talking about this. Like, what are the narratives of inflation, narrative understandings? And we thought that's quite interesting because it isn't straightforward, money causes inflation. There seemed to be some kind of uncertainty or dispute or contestation about it. There was an attention to corporate profitability in concentrated markets. There was an argument coming from people like Charles Goodhart about demography, which was meant to take a lot longer, but maybe it's shown up somehow with the sort of the fracturing of globalization that you got with the COVID crisis. So we thought, well, there's something there. The second one was what Nick called monetary austerity. We'd both done books on austerity a decade prior. And Nick said, well, the other thing about this, of course, is the notion that we all suffer from inflation is just frankly wrong. If you're in the bottom 20 to 40% of the US income distribution and there's a 10% inflation, that's a really serious hit to your income and your consumption because ultimately you spend most of your income on consumption. If you're in the top 20% and your financial assets, they raise interest rates and a vanishingly small part of your income goes to consumption, you actually benefit from this. So there's a distributional story that we wanted to tell. That's quite interesting. And then the last one was stimulated by a paper I received at the start of the pandemic from a friend in the United States. And it was a paper from Alan Blinder, the Princeton economist and ex-central banker, who has done a series of NBER papers that basically challenges the notions that the 1970s was correctly understood. that rather than money getting out of control, governments being able to, face down unions and the sort of the standard ingredients in the sort of cost push slash wage price spiral story that we grew up with the heroic central bankers and enlightened economists riding to the rescue and Volcker causing a big shock and CBI follows afterwards. That what actually happened was this series of supply shocks that just happened to all come along back to back. In the book, we refer to it as the London buses model of inflation. Any one supply shock you can see through, any two or three coming together starts to look like a systemic problem. And Blinder in his paper listed a whole series of shocks through the 1960s into the late 1970s, which led him to conclude that money really wasn't the causal factor. Now, I didn't want to get into a big fight with all remaining monetarists. Some of them have taken great offense at the book. And I want to underscore, I do think that monetary inflation happens and is possible and has happened in many places. But it just didn't seem to be what was going on in 21, 22. So you can look at the Biden stimulus, for example, right? 1.5 trillion in compensation for sending the labor market home. When you take the Fed data on what people actually spent the stimulus checks on, it was back rent and credit cards, which is hardly overstimulatory. These were compensations rather than stimuli. And if you're looking for M2 jumping up to cause it, well, you're not going to find that if you go to Germany with a balanced budget and the Schwarze Null. So that's clearly what wasn't causing it. In fact, just look around, you know what happened. Europe lost its gas station and it took a year for it to find Qatar and American LNG. It was a giant supply shock. Now, on the standard view, I meant to look through supply shocks, but what if these things are the primary cause? So this gave us a way of thinking, go back to the 1970s, rethink these lessons and see what we can go from there. One of the other things I wanted to do was whenever there's any sort of inflation, you will get people coming out going, and next it's Weimar, right? We're going to have hyperinflation and we're all going to die. So we spent time and actually did a whole chapter on hyperinflations, like what actually causes these things, which is essentially the breakdown of your state and its complete collapse. Or alternatively, Latin America, Argentina being the poster child, Venezuela could be this one as well, whereby you're incredibly dependent upon the export of one commodity. That commodity is highly volatile. You get caught into a super cycle. Eventually, the price crashes, which means your currency crashes. And because you import everything else, then of course you're in real trouble. Your balance of payments gets out of whack. And then the government prints the money for the import. So, yes, money's included. But this brings us to sort of a fulcrum that we have in the book, which is in reply to Friedman's famous line that inflation is always and everywhere a monetary phenomenon. There's a treasury line, which is shootings are always and everywhere a ballistic phenomena. Yes, bullets are involved. You can't be shot without them, but they don't actually cause the shooting, do they? So maybe there's another way of thinking this. And what we wanted to do was to say, and with a very open mind, we weren't sort of, we are out to prove this or whatever, that maybe if we think of this as sort of supply shock driven with monetary components rather than money as the fundamental cause, this could actually help us do something, which is take Blinder's reading of the 70s and in a sense apply that to the 2020s so we can explain both. Because otherwise, if you think about Germany, where I'm sitting just now and Thomas is sitting just now, then what happened was very simple. You got hit with a couple of big supply shocks, one through global supply chains and the other one through gas. And when both of those things were resolved, unsurprisingly, the inflation peaked and then died down, and that was it. So, taking that forward, what are the lessons from this? Happy to talk about any of this that you want on the distributional story that there are people and firms and companies around the world that made out like absolute bandits from this. People make money off of inflation, whether it's in concentrated markets, whether it's in the financial sector, because banks don't pass through the interest rate, the residual that they get from rising rates. Whether it's from people holding particular assets that are advantaged in periods of inflation. In terms of the sort of the narratives of inflation, we did an academic paper actually that's been published in New Political Economy that uses an LLM to actually trace how central banks talked about inflation. And they didn't talk about it as a monetary phenomenon. It's kind of interesting. There's variation across the big three central banks, but essentially all of the things that were out there in the world talking about this, whether it's because of the labor market or whether it's a supply shock or whether it's corporations pushing on margins, all of those discussions were actually present in the central banks themselves. Something else that's really worth noting, I think, is that one of the lessons of the 1970s, which is, jack up interest rates and inflation will fall at the price of a big recession, none of the big central banks pushed their policy rate above the real rate. They didn't do a Volcker. They basically raised rates from a very, very low baseline, zero, to around 5% and kind of held it there, maybe with like, half a percentage point difference. That wasn't the 1970s, that wasn't the 1980s. That wasn't, let's cause this big rupture. And in part, it's kind of obvious but interesting to think through why that's the case. Particularly in Europe, where you'd had both sort of the austerity response, the doubling down on exports, the squeeze on wages, the sort of the eternal recession mechanism, which I wrote about in my austerity book a while back, that when you've squeezed your population to that extent, if you think you're going to make 20% of them unemployed just to keep asset holders whole, you're going to be making enormous political risk. And it's interesting that no one did that. This time around, the central banks, whose research we consumed lots of, they kind of knew this. They were not monetary hawks. They were not out to slay inflation at all costs. They traded off against other goals. Indeed, if you look at central bank research in the decade prior to the inflation, it's all discussions of whatever happened to inflation. Is the Phillips curve still a thing? How should we think about a world where it's gone? So let me wrap up by saying it's not here at the moment, but if you have this more supply side money augmented view of inflation, I think it travels quite well and it tells us a couple of things about the future. First of all, we are either deglobalizing or de-Americanizing the global economy. And with that, not just because of tariffs come supply shocks and come price shocks. And those things are going to be important going forward, which suggests that price levels will become at least more volatile. And the other big one, which the Potsdam Institute on Climate Research has been all over and other people are beginning to get into, are the costs of climate change. Europe is warming 3 times faster than the global average. The Po Valley is drying out. Spain is drying out. Scotland, where I'm from, has wildfires. Like that never happens, but it is now. And once we absorb those shocks, then this is going to have effects on food webs. This is going to have effects on agriculture. And all of those things that are much more supply and less money oriented are going to have effects on basically price levels. So, in our reading of events, yes, there will be deflationary aspects going forward, no doubt. China's massive exports of green tech into different countries, the diversion from the United States, all that's going to, in the short term, at least push prices down. But we're doing a lot to push prices up. And the things that we should be looking at are perhaps broader than just the money supply. And that's basically what the book says.
Thank you, Mark. Very fascinating going through the ideas. I have an immediate question from Martin Sandbo from
Hi,
the.
Martin.
Hi, Mark. I hope this is working. Can you hear me?
It is, yes. Good to see
Very
you.
good.
Haven't
Good.
seen you in ages.
Nice to see you. Thanks for having me, Thomas. I mean, it's fascinating. I haven't read the book yet, but I look forward to doing so. Just two sort of comments slash questions, I guess. How you think about some things I thought was quite important in this whole episode. So you set out the kind of political division between the Krugmans and the Summerses. Um, what they had in common was that, both views sort of expected that rising interest rates, central bank interest rates, would cause slowdowns and maybe unemployment, right?
Right.
For the Summers camp, it was this had to be done to bring inflation down. For people like Krugman, and this was my view too, uh, this would be a terrible mistake. You shouldn't increase
Mhm.
interest rates so much because you didn't need to, but you would cause unemployment unnecessarily. Of course, what we got was higher interest rates and no big rise in unemployment in the US, at least. I mean, we had a slowdown in the eurozone that may have been interest rate driven. But I'm just curious, how you have you thought about why didn't we get that much of a slowdown? So we increased rates by 5 percentage points roughly
Right.
across the advanced economies. We didn't really have as much of a slowdown that we would have expected. So that's kind of the first comment slash
Uh-huh.
question. The second one is that the one word you didn't mention in your presentation now was expectations, right? Or maybe I
Yeah.
missed it. Uh, but when I was pressing central bankers on these arguments, it always ultimately came back to
Yes.
expectations as the thing that the argument had to hinge on to
Yeah.
make it all add up. And the idea was if we don't raise rates, expectations will start to drift, and then we get self-fulfilling
Yeah.
inflation. So I call this sort of Jedi central banking. It's all
Yeah. Yeah.
about using things to try to keep people expecting low inflation. Um, But the problem with that is that it seems to me you can never quite be sure that it's true. It's always sort of observational equivalent to something else.
Totally.
And I haven't really thought beyond that, but maybe you have, because that's kind of that complicates the political economy, right? What do you
It
do
does.
with a system where you have central bankers basically claiming this power to manage people's expectations, and it's very hard to assess whether they do. So, two
So,
challenges.
so let me try and bring the two of them together, right? So remind me to go back to expectations. Well, I'll take the first one first, right? If you go back to 2004, 2005, 2006, having 4% policy rate was normal. Like people have completely forgotten that money used to cost something. And then we had an enormous period where it was nothing, and it gave us crypto and SPACs and all sorts of volatility enhancers. But it's not actually that expensive. You know, basically the sort of capital should cost something, and therefore when you put it up there, it's not that bad. Secondly, the global economy is certainly taking some hits, but at the same time, there's a lot of dislocations in labor markets. There were shortages coming out of the pandemic. There was allocation issues. So there's lots of sort of like micro things that you could point to as to why, you know, you didn't get this one. But I think that the fundamental one is it just wasn't that big a raise. I mean, if you think zero is normal, then five is huge. But if you think historically four is normal, then getting to five with an inflation of 5.5 is this is noise in the system, right? Second thing is on expectations. We really went quite deeply into this. We didn't intend to, but we started to do it. And it was prompted by that Fed paper in 21, about 2021, about sort of expectations, expectations. And in other words, if you sort of like go looking for empirical indicators of the fact that people actually pay attention to central bank signals and incorporate this into their wage agreements, etc. Outside of a couple of trade union economists in Sweden and Germany, very few people actually seem to do this. There's very little empirical work that this expectation channel worked. And what we have from surveys, for example, shows that either the public really doesn't understand inflation or alternatively gauges completely different things from the same metrics, right? So I'll give you two examples. People consistently assume that higher interest rates lead to higher prices because it makes their credit more expensive. So if you're running an expectations model where we're raising prices and we're raising the interest rates and that's telling you something, if they really think that, they will obviously misinterpret what's going on, right? And the second one, and this is my favorite example in the book, there was a paper from a bunch of Santander and Bank of Spain economists about 10 years ago, and they scraped the web of New Zealand. Who knew you could do such a thing? And specifically, they looked for people in the financial sector passing information around because New Zealand has had inflation targeting for 40 years. And they found that you were like 100 times more likely to pass around a cat video than an inflation forecast. And that was in the financial sector. So this entire sort of edifice of expectations, which really comes out of the fact that monetarism wasn't a credible theory for macroeconomics. And it settled onto an expectations model once that one blew up in the early to mid 1980s, has created a world in which everything was deflating, central banks more independent. They told this story about expectations. Was that what was really going on? Well, when you look into the cross-country regressions as to who has central bank independence, who doesn't, yes, there was an initial period up to 2000 when if you had high central bank independence, you deflated faster, but the rest of the world deflated too. And there's lots of reasons to do with technology, globalization of labor supply, IT, etc., as to why prices fell for 3 decades. So we came away from this whole thing quite skeptical that, and in a way, and I want us to be a supportive skepticism. When you make them into Jedis, you expect them to do miracles, right? And you're setting central banks up to fail because all they have at the end of the day is raise and lower the price of money and then buy and sell assets. And if you think they really control everyone's expectations, then you can ask them to do more than they could ever probably do. And I think that's the risk, that in a sense we overpromise and underdeliver. And what the central banks themselves were, they were quite conservative in a small c sense about what they were claiming and what they were actually trying to do. So that's how I would think about that whole matrix, Martin.
Yeah, very, very important question, I think, still, because that's some people would still from the other side say, well, in the end, it was they managed expectations and that was the way they contributed to the downward trend of inflation at some point. It strikes me at some point, if you look at whatever, if you ask people, normal people, what is a central bank and what does a central bank do? I mean, and most people don't really know. So believing in the power of their expectations management is quite a very ambitious idea. So maybe, and I don't know if you get some numbers, some figures in mind, but I remember that in the high times and when inflation came down, at least for Germany, if I remember correctly, the expectations were more lagging than leading.
Yes, no, absolutely. Well, my favorite example for this one is the so-called disconnect debate that happened in America around 23 and into 24 and was supposedly central in the election, which was that, here's the experts. The experts basically look at the glass of water and they look at the surface tension. They basically look at the delta, the rate of change, right? So we say inflation's going down because it's not going up as fast. People don't experience the delta. They experience how much water's in the glass. And if it's going up, things are getting more expensive. So they look at levels, we look at rates of change. So we can do our best estimates and best guesses of how, strip out core, go to core, strip out volatility, etc., and tell people it's 4%. But if you're in the bottom 20% of the income distribution, that 5% inflation is an enormous tax. And you will notice when you go to the supermarket that things haven't gone up by 4%. They've gone up by 15%. They've gone up by 20%. Boxes have gotten smaller. It is harder to do this. So their subjective expectation of inflation is 10 to 12%. Now, credit to John Otters at Bloomberg. He basically figured what was going on and said, if I take the whole time series the Fed uses and then strip out all the volatile stuff to get to core, I'm getting a low number. What happens if I strip out all the non-volatile stuff and just look at volatile core consumption items, food, fuel, rent, etc., which take up the bulk of sort of low-income people, middle-income people's expenditure? If you do that, what you end up with is an inflation figure which is much closer to the subjective estimates of the public than the expert real figure. Now, what does that tell me? If you're running an expectations model, either your signals would be completely incredible because it doesn't at all level set with what people's subjective expectations are, or they're forming expectations on a basis which has nothing to do with what you're doing with your policy rate. So, that to me, there was a very important bit of information in that.
Despite of these arguments, it was at the time, if I remember correctly, the fact was that inflation stayed longer than the real shocks at some point. I remember that at some point it was difficult to say it was just the shocks, and then immediately gas prices came down quite quickly and other prices also. But inflation stayed. What was your interpretation of this stickiness?
Well, there's lots of ways you can account for stickiness. I mean, someone has put in here, Philip Peter in the comments is that I talk about Isabella Weber's idea of sellers inflation, greedflation. And of course, when one of the chapters in the book is really about what happened to Isabella on Twitter, which was she wrote an 800-page thing in The Guardian that said, this is basically supply shock induced, maybe we should have some price controls. And the whole of econ Twitter just went for her in a really unpleasant way. And it was this thing that she didn't realize that what she'd done is she'd touched the third rail. Because if inflation could be caused by such factors, then the expectations model and all the stuff that people got their intellectual capital invested in kind of gets bypassed, right? And then you can start to explain persistence by things like, I don't know, why were eggs so expensive in America in comparison to Canada? They both had bird flu to deal with. Well, there are about 12,000 producers, but there are basically two buyers. It's a highly concentrated market, and they're able to push, not just protect their margins, push on past that. In 2023, the ECB estimated that 40% of the inflation in the Eurozone was sellers' inflation. In other words, it was driven by corporates. So that would be your persistence. You don't have to invoke my grandmother's expectations of future prices, right? Just basically market structures are in such a way, you have concentrated markets, And, I think a better way of thinking about Isabella's idea of seller's inflation isn't seller's inflation. I like to call it, well, you would if you could get away with it, wouldn't you, inflation? I mean, the whole point of being a capitalist is to make money. If suddenly there's uncertainty over prices and I can push up past my margins and sustain that because the market isn't competitive and someone else is going to come with me, they're going to follow me, and we're going to push the general level of prices up, well, that would be fine. Is there any evidence for this? Well, let's just say that corporate profits in the United States 3 years out are at 12.5% of GDP and have never been higher. So I think there's plenty of ways you could explain this stuff without resorting to that.
Taking this point, Isabella has developed some ideas on how to fight such an inflation, shock inflation, and also seller's inflation, because this is nothing you should probably fight with interest rates. What is your take on that? I mean, what is the specific other answer that you should give to such an inflation?
So, whilst we are sympathetic to there's more going on than just the usual suspects, we actually did a kind of a deep dive into the notion of doing price controls. And the problem with it is that sometimes the economists are right. So, for example, in Hungary, when the inflation hit, the government said, right, supermarkets, you can only charge this, and very straightforward stuff. Guess what? There were shortages in the supermarket and there was a thriving trade in the black market. That can happen, right? Scotland tried to regulate the price of rents, but they did it in such a way as it created incentives for landlords to become very, very short term on their leases. And that ended up reducing the supply and increasing rents rather than controlling it. Conversely, in Spain, rather than trying to control prices directly, they subsidize consumption by subsidizing spending on such things as public transport and fuel bills, etc. And therefore, you accept the inflationary aspect on one side, but you reduce it on another side of the person's balance sheet, and that seemed to work. So there's a kind of ex post ex ante problem here, right? You don't really know ahead of time if something like this is going to work. And if you try it and it looks like it works, then you have an identification problem. Was it really that caused it, or were there other things that caused it to end? So my basic line on this, and my co-author's basic line on this is that we should have a kind of Swiss Army knife approach to thinking about inflation. It shouldn't just be one thing, one problem, one reason, one set of policy responses. If it looks like supermarkets are highly concentrated, and as someone has just put into the chat down here, individual product prices can jump up by 50% randomly. Yeah, you don't need to look to M2 for that one. Ask the supermarket what the hell they're doing.
And then when they say, yeah, we're doing it.
Well, this is where it gets complex again, because then you have to have data on input prices. Right, you actually have to know what all the input prices are and what the final demand is, and then do. It's pretty complex to work this out. But look, there are simple examples of this, right? Think about interest rate pass-throughs. Now, everyone has a savings account. Your savings account was probably paying you 1% before inflation happened. Policy rate goes up to 5%. Did your savings go up to 5%? Not a chance, right? So they didn't pass it through to savings. The banks took it as profits. Italy even tried to put a tax on it as a windfall. Think about oil companies. Oil companies made an absolute fortune. By one estimate, US carbon majors made 220 billion above normal profits just in 2022. Now, if you think that who owns those shares, it's the top 1%. So the top 1% is 330 million people. So let's take those 330 million, 3.3 million people out of 330, and then give them half of that increase through share dividend payouts, through share appreciation. So you're talking about 100 billion divided by 3 million people. So they did well just for having shares in Exxon, right? So, the distributional story on this actually just it's much more complex than we think. And, this is why we wrote the book. We wanted to get into this. We didn't have any answers. We didn't have, it wasn't like I'm taking down monetarism. There was none of this. It was just like, how should we think about this? And this is the best that we came up with.
Yeah. Very sympathetic approach to compared to especially some of the, let's say, traditional orthodox economists who pretend to know it all and have easy answers. So that's sounds very much more realistic to go this way. Isabella Weber, in her model and her analysis of this inflation, shock inflation, she very much comes to the conclusion that we should start very much early, at a very early phase of inflation, and then identify if it's, I mean, that's what you say. It can be monetary money, it can be demand driven, but it doesn't have to. So one question that is important is it possible to have a very early idea of what inflation it is and proven? It seems, in hindsight, it seems often quite more or less easy. But even then, I mean, you're talking about the 70s, and you're contesting the idea, the mainstream idea of what this has been. So what do we need? Is it easy? Is it possible to?
It's not easy. So, for example, looking at the chart, and I mentioned sort of climate change as a possible driver, and they said, well, forest fires are caused by arsonists. I'm like, I'm sure they are, but they're not causing the oceans to warm, and they're not causing biowebs to break down, and they're not causing Greece to be 50 degrees. So, these things are there, and we can choose to interpret them in different ways and ignore them if we will. But, and my line on this sort of stuff is it's like arguing with physics. Physics doesn't care what we think about certain things, it just does and just is. And I think that we should think about inflation and economic problems in this way, in the sense that these are just the real things in the world one has to adapt to or deal with. And in that case, you should take a very open mind as to what the possible solutions or possible mitigations for these things are, rather than having one preferred view. So let me break into the story of the 70s for a little bit. I mean, this is Blinder's story, but we augment it a bit, right? So what would be an alternative rendition as to what happened? Well, let's remember the standard story. Standard story was governments became overloaded. You had big unions. Those unions were constantly pushing wages up. And so long as you could augment productivity ahead of wages, you could pay for real wage increases, you didn't get inflation. By the time you get to the 1970s, this had begun to broken down. Labor becomes too powerful. You start to get these wage price spirals. They didn't know what to do. They made it worse by basically spending more money. They really needed to do some version of austerity. Eventually, they figure out push up interest rate through the central bank. That's the story. Now, what would be a different one, right? Well, a different one would be around 1965, the United States starts spending an enormous amount of money on a huge war in Southeast Asia that it never declares in the formal accounts. That has a knock-on effect onto the US labor market, such that by 1968, the real unemployment rate's less than 2%. This creates a kind of Kaleckian dynamic whereby the dumbest people in your firm can leave work at 12 o'clock and get a better paid job at 4. Ultimately, profits crash. This is when capital begins to revolt. All of that can be fitted into the standard story. But there's a whole bunch of other things that went on. Number one, the incorporation of minorities and women into the labour market at scale in the late 60s for the first time. They don't form households the same way as regular white dudes. They just act as consumers in already supply constricted markets. What else happens? Commodity shocks. We've got Anna mentioning commodities there. Commodities are super important in the 70s, not for speculation, but the global wheat buffer stock that we had was completely depleted. You had bad harvests in the Soviet Union and Canada. We had 2 oil shocks in a much more carbon dependent economy, which had huge producer cost effects all the way through the system. So you can basically break this out into a series of things on their own that were a bit like the COVID shock, but they just lasted a decade. Now, if you view the world that way and you think about the world that we're possibly moving into now and what happened to us over the past couple of years, that suggests to me that if you want to be prepared for this sort of stuff, you should think of it kind of in those terms. So, what are those possible shocks that we could get? You think about Trump's tariffs in this way. Trump's tariffs are policy-induced supply shocks, quite deliberately trying to raise prices so that they can achieve certain ends, whether those are revenue ends or reindustrialization or whatever the particular goal is. So, in a sense, we do this all the time. Another one we found out while we're doing this quite interestingly is this notion that we never do price controls is complete rubbish. Have a look at electricity markets. They're nothing but a series of controlled prices. And in the United States, healthcare, it's 20% of GDP. It's an enormous market. All the prices are negotiated. There are no market prices. So there are huge parts of our economy that we just pretend works like it, like price is the dominant thing, when in fact this isn't at all the case.
Mm. But anyway, Anna has raised the question of commodities, and that's also the point that I have in mind from Isabella, to say that, I mean, one of the problems was that you have a kickoff of commodity prices like gas prices and so on, and then it went crazy. It went to levels which were crazy, and that has produced extremely high inflation rates quite quickly afterwards. And by the way, at the same time, the AfD in Germany has risen. We may come back in the next step to this political dimension. So wouldn't it be necessary to have whatever systems, buffer systems, or allow to stop speculative spirals at the beginning, instead of waiting for it, because you won't have interest rates helping.
Well, I mean, that's the identification problem I alluded to earlier. How do you know that this particular set of interventions are the thing that's going to spike this, right? So, I mean, even if we think about the pandemic, if we think, well, did we really know that global supply chains were as vulnerable as they were? No, because we'd never really shut them down before. Did we know what kind of effects that this would have on the labor market? No. So, in a sense, to be perfectly fair about this type of approach, it presumes having a knowledge of the state of the system at a given point of time that we don't actually have. And if you really try and intervene on that basis, the chances are what you're doing isn't going to work out. And if it does, it might be as much luck as good choices. And we don't really know how to distinguish between the two. Now, this is not a counsel for not doing this stuff, but is a counsel for saying, how do you really know that movements in X and Y are the things that 3 months from now are going to be a problem? You need to have some kind of story as to why that's the case. You can build many of those stories. Monetarists love M2. Just look at M2, that's it. And it's like, well, Germany had higher inflation than the United States. M2 was flat. What do we take from this, right? So it is that problem of figuring out before it happens. After the fact, we're all very smart. Before the fact is very difficult. Another one of Isabella's proposals, which is completely reasonable, is buffer stocks. But the problem with the buffer stocks argument is you could have done something else with the money. Or in the case of governments in Europe, or at least for the way they've behaved until very recently, is they don't want to spend money on anything, let alone a buffer stock. So, if you're actually trying to build ahead and do this sort of stuff, it kind of requires a fiscal system and an understanding of what government should do that I think is sorely lacking. It's a bit like green planning, right? The main problem with green rollout isn't actually the tech. That's all fine. It's the financing, but you could probably do something about that. It's the fact it's the complexity that's involved over many years. So ultimately, you would need, I hate to use the word because people go mental when you do it, but there was a piece in the FT about this the other day. You do need some kind of planning function to basically overcome these coordination problems over time. Planning in any of our economies? Well, we can barely plan for next week.
Mm. Yeah, but maybe that's the result of some decades of not considering these questions at all, and so we didn't learn how to do it. I mean, and that's looking forward. If you're talking about climate as one remaining factor that may cause other inflation shocks. What might happen? I mean, you have a drought, then commodity prices will go up, then there will be speculation, and then this will drive inflation above.
So,
I mean,
but, I mean,
some
but the
inflation.
underlying problem is, this is the sort of the seller's inflation model to a certain extent. This type of inflation driver doesn't start inflation. It needs it to start somewhere else in order for it to happen. And speculation, you can do the same thing with 2006, right? Where mortgage derivatives and derivatives written on collateralized loan obligations absolutely central to the crisis. Yes. Were these objects of, pardon me, speculation, in the sense that they were investments that people were rating higher than they were and were using them for various purposes? Yes. Were they the cause of the housing market collapsing? Well, that's where it gets a bit trickier. I mean, they were dynamiting the building, but it's not clear to me that that's why the building blew up. There were other things going on, right? So it is this problem again of, I hate to say it, but it is again this problem of identification, right? So what happens if you ban all commodity future settlement, right? Or you regulate it so that you treat it like wine futures, right? You have to take physical delivery of the case. you'd shut down a lot of financial speculation and financial profits. That might be good depending on your normative stance. It might not. Would it be more difficult to smooth agricultural and other markets? Maybe, but maybe the speculation outweighs that. Would that get rid of the problem that climate change is going to drive supply down? No,
Mm.
right? So, if we think this through, if I'm worried about what climate change over time does to food supply in Europe, absolutely, I don't want speculators profiting off of that fact, but I'd be more worried about the Po Valley drying out.
Mm. I mean, it's in the end, it's also a question of what is at stake. And maybe in normal times, let's say in normal times, and if you are a monetarist or whatever, and you say, well, you need to raise interest rates, and after time, it always takes time, but then it comes, and then there is a recession, and then inflation will go down. But if we're in a case like today, and that refers to what I said earlier on the AfD in Germany or on the US elections, if what seems to be plausible, uh, Trump has won the second term, uh, also because of, or maybe it's even essentially because of this inflation period. And if you look at the data, and that's something that Tom Krebs and Isabella Weber have done and others, you see quite clearly that the AfD, the latest swing they got, was very much in this period of the double-digit inflation rates in 2022, or still 21 starting. Then there's much more at stake. I mean, then you can't allow for, I mean, that doesn't
Yeah.
invalidate
No, I hear you. I hear, but let's do a counterfactual on this. If we hadn't had any inflation in those periods, in my opinion, Trump still would have won. And there's multiple reasons for this. My short version of it for American politics, where I've lived for the past 30 years, is the Democratic Party have become the people who shop at Whole Foods. They're basically the party that represents the interest of Bannon calls them the professional managerial classes. They're the people who are relatively insensitive to inflation themselves because you shop at expensive places like Whole Foods. And your ability to mobilize a cross-class constituency that reaches down to people who've been massively disaffected and disadvantaged by the things that have advantaged you and your assets is extraordinarily limited, and nobody believes you anymore. So even without inflation, I think that, inflation, the rise of economic populism predates inflation. Was it the case that everyone who was an incumbent got blamed for inflation because it made life tough? Yeah. Why was it tough? Because of what we've allowed in many, many countries our income distributions to become incredibly unequal. So that basically in the US, to take one of the standard measures, bottom 60% haven't had real wage increases in real terms for very long periods of time. Incredible wage stagnation at a time when prices are seem to be constantly increasing. That alone will piss people off. Right. So, let's not overweight inflation on this one. The roots of what's happening now are much deeper and travel much further than just that inflationary moment. Now, the question is, what happens when these people get into power? Well, you're beginning to see it. They monetize it. It becomes crony capitalism. It destabilizes financial markets. The outcome, the immigration policies become basically barbaric. It's not good. But, it's not just the inflation is driving it there.
Mm. One other factor that you're mentioning, looking forward, is demography, and you already alluded to that. One simple question: why does Japan, with a very low demography, which has been for a long time, not have had any inflation? To the contrary. So is it true, or is it plausible that demography is the demography that Western countries will have a all in all inflationary impact?
The Japan one would be deflationary impact. So that the standard model would be if you interact the demographic distribution with the income distribution. If you have a pretty equalitarian income distribution, then all things being equal, young people consume and old people save. Banks sit in the middle. That's why you get this generational transfer, and that's what kind of creates wealth, right? When you have a highly unequal distribution, when you get pensioners in poverty, they're not spending enough. And those at the top end, the top 20%, have more assets than they'll ever burn through in their lives, and they save it and they pass it on to their heirs, and that creates the next level of intergenerational inequality. All of that is deflationary, right? So demographics on its own, if you're just saying old people, very straightforward economic logic would say this is deflationary. What could be inflationary? Well, what happens in such a world is that you get loads of people who need housing, but you're not building enough houses, which is the state of every country. And then your housing stock depletes, but at the same time, the costs go up. That creates more housing stress and pushes more people into an expensive rental market. And then they feel that their prices of what's happening to them is going up. But this is actually tied into an asset maldistribution that has to do with demography and aging. So, again, 30 years in this game's taught me one thing. If anyone's telling you there's a monocausal explanation for a complex phenomena, just stop believing them, right? There's usually other things going on that cut both ways. So think, for example, just now, Trump's tariffs pushing prices up. Eventually, it's got to show up. That's having this terrible knock-on effect to the European green industry. We have this 80% complete wind farm that's just being canned off of Rhode Island, where I live. This is very bad for the Danish wind manufacturers, etc. You know what else is really bad? You're going to get all the green tech from China that's never going to make it to the US. Now, from a planetary point of view, more and more green hard tech, more decarbonisation. Why? Short term to medium term, if you're a European firm, this is a disaster. So falling prices can be as bad as rising prices. And there will be rising prices because of the other factors we talked about. So, I just think about it this way. We had a very strange period of extraordinary low volatility across all financial and economic indices for a very long time. And it's over. And now we're back in a world of volatility whereby things go up, things go down, and you don't quite know what's coming next. Inflation is one part of that story, but there are deflationary forces out there as well.
Mm. Is that true? Because going through the arguments, which are some often have been mentioned in the midst of the inflation period on like globalization, climate change, or climate policies, and then the demography as something, the German inflation forecasters and the pessimists always said, well, these structural factors anyway will push up inflation, and so we will
Yeah,
have.
I mean, maybe you can explain that one to me, Thomas. I remember that at the time, and I never quite understood it because the standard model would be they save too much and therefore they won't spend enough. So they could see secondary inflationary consequences on things like, housing stock or whatever, but I never quite got that one. The main demographic one is Charles Goodhart's argument, which is essentially that what actually happened was around 1990, 500 million people joined the global labor supply. You were able, because of IT, to move your capital towards cheaper labor rather than importing them into your country, which we did both of. This pushed down wages, pushed up profits, and pushed down the rate of inflation. Those cost advantages are now ending or going into reversal. And prior to Trump, he said all this, Trump too. And you would expect, even with relative political stability, then for inflation to go up because the factors that had been pushing it down, 500 million people joining the labor supply, for example, the one-time gains of the IT revolution, they're going to go away. That one makes sense to me. Old people causing inflation, I really never got that one.
On the globalization and technological impacts, I mean, put both together. One argument would be to say, as you also do, that with China not being such a competitive factor, and then tariffs and others, that's sort of a deglobalization, and that's is putting away the deflationary impact that has been acting for decades. On the other hand, I find striking, you mentioned some examples of products like cars and the Golf example and others,
Yeah.
who, when you calculate the price, have gone down enormously, like also solar panels and others. So I mean, do we also not know
Yeah,
exactly
we
what?
don't. This is it. We don't know. I mean, I'm glad you picked up on that. This is one I do at the end of the book, which is basically I calculate. One of my favorite cars was the Golf GTI. First appeared in 1978. Didn't have power steering, didn't have ABS, didn't have airbags, had carburetors. I mean, it's just a very different beast. Classic, but still a different beast, right? And the one you get now is a spaceship in comparison. And yet, if you price it in $1978, it's a third cheaper. Why? Because of competition. Because what capitalism does is it makes things cheaper over time because other people do it. And if you want to stay in business, you have to improve your quality. And this is why cars now have all those toys that they didn't have in the 1970s and so on and so forth. So, traditionally, what capitalism does is increase supply and push down price, and the two of them are related. And that's, in a sense, why we put up with it as a system. When you get to a world whereby you have these discrete shocks, which may increase and become sort of systemic, particularly again thinking of climate, that's going to cut against this. But you and I can tell completely different stories about demography. We're all getting older. How's that one going to work out? I mean, I just don't see the Italian economy, given its structure and given its demographic profile, going into an inflationary spiral unless they left the European currency and just decided to go mad with the printing press. And even then, that would probably dissipate because there's nothing real for that to catch on to. So I think, again, this comes back to sort of why write the book. At first, I was kind of disinterested. I didn't think there was much to investigate or to say. But the more that we got into it, the more I began to rethink things that I thought for a long time. And I don't think any of this is settled. It's not even settled in my mind. Um, the main sort of thrust of the book, A Guide for Users and Losers, is the distributional story, right? Not everyone suffers. Some people gain, people suffer in different ways to different degrees, and it's important to recognize that. Could there be sort of non-monetary factors involved in this? Yes, but that doesn't mean that money never matters. If you want to be an essentialist about this, you have to show me that every time there's inflation, it's not just correlated with M2, which it often isn't, that somehow you've got to get past the model of fractional reserve banking being true because it's endogenous money. Banks lend on the expectations of profit, not because the central bank's given them more money. I mean, at this point in time, the problem we have is we're paying banks 20 billion a year in the UK to park the reserves and not do any lending on paying interest on reserves. I mean, this is miles away from some kind of the central bank has printed all this money and now we have out of control inflation, and the mechanisms are completely different.
Mm.
Right. So I just think we just kind of have to update. And, some of this stuff I'll be wrong about, absolutely. But I'm willing to be wrong. It's how you learn.
Yeah, yeah. I mean, that's probably the way it is, and that's what it is. But nevertheless, these guys at the central banks, wherever they are, Jackson Hole or in the countries, they need to be prepared. I mean, they won't be able to wait until we have better understood. So,
But
what
this
would
goes
you
back
say?
to what I said to Martin about the unfair expectations, right? In a sense, when everything's going well, the world's deflating and the world's got positive growth and all incomes are rising, or at least it looks like that for a while. You can hang around and tell yourself any story you want about expectations control or whatever. It's great because there's no consequence to it. And when we got to the financial crisis, what we needed to do was to basically say, okay, either we take a chance and hope that this bottoms out and then we spring back, or alternatively try and cushion the blow. And we decided not to cushion the blow and we went for the spring back and it didn't, and Europe lost a decade's worth of growth. The folks who were in charge then are still the folks who are in charge now. And we said something really unfair to them. You've got two tools: raise and lower the price of money, buy and sell some assets. Can you please sort out the giant hole that we've got ourselves into? It was a totally unfair mandate. We've empowered these institutions to be Jedi temples, and they don't have the Jedi powers. They really don't. So, my line on the central banks is the vast majority of them are good, hardworking people working within a framework with a set of tools which are inadequate to do what they want, what they know they have to do. And if you look at central bank research, go read the research. They know this too. That's the thing, right? This caricature. I mean, there may be some central bankers who are like, oh, I looked out the window and there's an inflation dragon. The vast majority of them are not like that. And their research departments certainly don't think that.
Mm. But that seems, does it seem or to be in contradiction to, the image of these central bankers and the old model that they have constructed over the decades, like we know how it is, it's easy, we have to just control money, and then we have one tool, and that's quite easy. And that fits with the model of an independency of a central
Yeah,
bank, which is if
and
they are
it's
so wise, you can give them all the power and they will do on their own. If they don't know, what does
mhm.
that mean for central bank independence?
No, it means there has to be a bit of humility on all sides. I mean, I just supervised a dissertation here in Germany a little while ago by a guy called Tobias Arbogast, and he wrote this fantastic dissertation about what he calls navigating by the stars. So the stars are sort of the unobservable constants of the macroeconomy, the natural rate of interest, the natural rate of unemployment, which you don't see directly, but you infer from models. And Tobias's point is, if you really think these things are real, and that you cannot by policy get past this, then it makes perfect sense to have the thoughts, frameworks, and policies that we have. But if those things are just model constructs and they're not really real and you can actually do things around them, then we're massively constraining our options and possibilities. Now, I want to talk to Marie just said in the chat, and I want to address this. Does this imply the ECB can print as much money as is needed to handle climate and environmental challenges? Well, no, because even in an MMT framework, they admit that inflation exists. They see it as a capacity constraint issue rather than a monetary constraint. But I think what we showed with the shocks that we had in 22, 23, inflation is real and it has negative distributional consequences and it's not good. So we can't just run the printing presses. I mean, I'm not a monetarist, but I'll admit that money matters to the extent that if you do this, if you run into capacity limits, if you run into there isn't enough people in the labor market to install the heat pumps. They don't have the skills to do the things that you want to do. Then literally, yeah, of course, you're just going to cause shortages and prices will go up. Hence why you have problems of complexity that require issues of planning and so on and so forth. So it does not imply that. There are monetary limits. You want to spend a ton of money and you will cause inflation if you try hard enough. There's no doubt about it. Money matters, but it's not everything.
We have some 2 minutes left, 3 minutes left, and maybe some the time to ask something which is very in the headlines. Is there anything you take out of what you've learned about inflation, about central banks, and what is happening currently in the US and the Fed, and the president of the United States who is firing a Fed member?
Yeah, they're trying to domesticate the central bank, right? So I had a chat with Claire Jones, who's the economics editor of the FT, about this the other day, and I said, look, I'm neither sympathetic nor unsympathetic to this. I'm unsympathetic to the notion that if it wasn't for central bank independence, we would have all died in a Weimar type accident 5 years ago or 10 years ago, whatever. I don't think that's the case. I don't think they're as powerful as we think. Would I rather have some kind of independent entity controlling the printing press rather than people who are like self-interested rent seekers? Yeah, actually, I would, come to think of it. Does that mean that central banks and democracy need to be divorced? Only on an extremely hard reading of time inconsistent preferences, etc., which things like the experience of Germany completely contradict because the biggest problem in Germany for 20 years is you haven't spent enough money, rather than politicians are always spending too much money. So there's room in here. And the risk is that, as well as on the one hand, saying these people can do more than they can is a risk, the other one is, in a sense, genuflecting at the temple too much, right? It wasn't the case that 4,000 years ago Moses came down with some tablets and it was inscribing central bank independence. It wasn't that long ago that most governments across the world didn't have independent central banks. And whatever one way thinks of it, average growth rates in the period when we had dependent central banks from 1945 to 1975 were twice that of the period from 1980 until 2005. So if it's so amazing and so great, why were the growth rates half? Why did we end up with horrible income distributions? Why did the wage share of GDP collapse? Why did assets become the way that you maintain your way in this world rather than your labor? There's lots of things that go beyond the ambit of central bank independence. Am I worried that the Fed is being politically screwed with? Yes. Do I think it's a bad idea? Yes. Do I think the Fed is the be all and end all of everything we can do in this world and they've got the right playbook? No.
Mm. But what would be the intermediate case between complete
So I
independence?
would recommend that people read a book by a scholar called Leah Downey called Our Money. She makes the case for democratic policy making reinvigorating both democracy and central banking. And the argument goes like this. Why are politicians so crap? because we don't actually give them any tools with which they would need to be responsible. We've taken away money, we've taken away fiscal policy, we've told them they can't do anything, they shouldn't do anything, and it's all hopeless. Consequently, when they get into power, they consistently disappoint because they don't try and do anything. Pace, Schwarzenegger, the entire Merkel period. And then you accumulate tons of problems, and people go, why haven't you done anything about this? And you go, well, we don't do that. This is it. Well, how do you go over that? How about basically bringing the tools back and saying to them, you're responsible for this too? Rather than the central bankers showing up and giving Jedi speak and everyone going, oh, that's great. Yeah, he's clearly got it sorted out. That you actually have credit targets, that you actually have goals of allocation for the finance in the country, that you think we are going to have to do X and Y on climate. How much money are we going to have to raise? How do you help us do that? Because if you're hindering us with a target that is completely disabling, that produces chronically low growth, you're not part of the solution, you're part of the problem. So democracy is not something to be removed from the special case of money because the politicians can't be trusted. That's populist dynamite. If you want to avoid a populist future, actually having a think about cordon sanitaires, experts running everything, and producing outcomes that really aren't benefiting the majority of people, that would be a good place to start.
Mm. Very good, very interesting. There was someone complaining that we were talking about the past very much. I don't think that this is in itself a problem. To the contrary, maybe it's sometimes useful because we're not in the midst of a high double-digit inflation, and we don't need to talk about the next step of the central bank. And it's maybe even, I mean, I understand the argument, but it's even wise and good, as you did, to look back and to try to understand, very open-minded, to understand what has happened, because that's usually the thing that happens in the midst of the crisis. Everyone is talking, there are always headlines and there's high disputing people, and then the crisis is over and nobody talks about it again until the next time.
Exactly. Then we have the same arguments again.
Yeah.
There's zero learning in the system. Yeah, it's true.
So that's why I find this book very helpful and very inspiring. And as you all said, I mean, you don't have the final answer, and it's all the more interesting to go through the arguments, to take into account these distributional aspects and other factors that maybe are not in the models, in the classical models. So many thanks, Mark Blyth. The book is called Inflation Guide for Users and Losers. And yeah, let's continue the debate, and probably at some point when the next inflation shock comes, we will look back into the book and discuss all this again.
Well, let's hope so, because it means I get the sales twice.
Okay.
Always a pleasure.
Have a nice afternoon. Thank you all.
Thanks to everyone for coming in.